G'day traders, and welcome to the first non-farm payrolls for 2025. In light of where the Fed's current policy stance is and where markets are trading, I would suggest that this number tonight is going to be super important and will move markets. Okay, so let's recap quickly where the Fed is at the moment. At the last policy meeting before Christmas, yes, the Fed did cut rates by 25 basis points, but it was a hawkish cut. The Fed told us in no uncertain terms that they had done the heavy lifting in cutting rates, and they aren't interested in cutting rates further. So if we're lucky, maybe we might get one more rate cut this year. The bond market has certainly listened to the Fed. We are seeing bond yields spiking aggressively higher and trending exceptionally well, and that's been one of the main themes in markets for the last month or so, or the last couple of months. So US 10-year yields at the moment going into payrolls are up 110 basis points from when the Fed started cutting. This is history-making stuff, guys. Never happened before. So US 10 yields at the moment, we saw a high this week of 4.73%. The high for 2024 was 4.74%. So we're only 1 basis point away from taking that high out. The US dollar has certainly listened as well. We're seeing the US dollar follow what bond yields are doing, and we've got dollar index trading up towards 109, above 109, at multi-year highs. The US dollar at the moment is a wrecking ball. So that is the state of play that we're seeing in markets at the moment. Going into this payrolls number, markets are on edge because what bond yields are doing, what the US dollar is doing, certainly we are getting to a tipping point where potentially we're going to start breaking things. So what do we expect from payrolls today? The headline number, we're looking at around about 160,000 jobs added, and for the unemployment rate, we're looking for about 4.2%. There are 3 outcomes here. One is a hot number. So a hot number is a number that is obviously headline number, maybe up around 200,000 or above 200,000, and potentially the unemployment rate dropping from 4.2% maybe down to 4.1%, or 4%. Hot number is the worst case scenario for markets because that will certainly spike bond yields. So we will take out that 2024 high at 4.74%. The next target for bond yields then, you're looking at the 2003 high, which was at 5%, and the US dollar will certainly rip as well. Not good. That combination, as we were just saying before, is we're getting closer where we're going to find a tipping point where we're potentially going to break something. The US equity market certainly maybe on a hot number. Initially, we might see a rally, but no doubt the smarter money, once they see what's happening with US bond yields and also with the US dollar, I would imagine that they will sell into any sort of knee-jerk rally on that number. But certainly, a hot number, even though it looks good, where markets are trading at the moment, is going to be very, very, very bad for risk with a bond yield spike. Okay, second scenario is it comes out as expected. If it comes out as expected, I think that's probably maybe the best case scenario for the markets, in that we're not going to see a spike in bond yields on the back of that. So we'll probably see markets maybe trade at similar levels and sideways on the back of a number that comes up as expected. The third scenario is that obviously we get a number that comes out below expectations. So we're looking at a number that maybe comes out below 100,000, and the unemployment rate goes up. On a number like that, obviously then we're going to see bond yields retrace from current levels, and they'll go a lot lower. And what we're seeing with the US dollar obviously will follow those bond yields, and we'll see a sell-off on the US dollar. And obviously equity markets will actually enjoy that. A simple fact, because the stronger dollar and what bond yields are doing is something that is very risk negative. So I hope everyone has a good payrolls experience tonight, and we'll check back in with you later.